What's up everybody, Nate here, and the housing market in the United States has recently been going through some pretty serious changes. Well, so as you get older, your market does tend to go through some changes. Don't worry, it's totally natural and it happens to every single market, but it is gonna hurt. Wait, what? Yes, the housing market right now in the United States is in a little bit of a pickle, but the more it seems to change, the more it seems like it's getting a little bit closer to what happened during the last housing market crash of 2007. Mortgage interest rates in the United States have hit 6%, the highest that they've been since 2008. Meanwhile, mortgage demand and new mortgage applications have dropped to their lowest point since 1999. All while it looks like no money down mortgages are starting to make a comeback according to Bank of America. These key aspects are going to be very important to pay attention to as they're going to determine how the housing market is going to look in 2023. So today I want to talk about what exactly is going on with the housing market, how these three aspects are very similar to what happened during the last housing market crash, and what we can expect to see in the future. All right, so let's start by talking about what is happening today. So the housing market has not been in a great place in the United States because of two major things: inflation and the Federal Reserve. Now, the Federal Reserve does not have a direct impact over mortgages or the housing market in general, but it kind of works like this. The way that people buy houses is by getting a mortgage. Most people don't have hundreds of thousands of dollars to put down on a home, so they have to go out and get a mortgage. This means that they're borrowing money from a bank or financial institution. But have you ever really thought where the bank or the financial institution gets their money? Well, they get their money from the Federal Reserve. The Federal Reserve essentially gives these banks a certain rate when they give them money, and that means that it costs banks to borrow money, just like you have to pay back a bank when you borrow their money. Right now in the United States, though, we have a Federal Reserve that is aggressively and very quickly raising its benchmark interest rates, which means banks that loan out money have to pay a lot more for the money that they use. And if they have to pay more for the money that they use, they're going to make it a lot harder for everyday Americans to borrow money from them. This is exactly why we've started to see mortgage interest rates rise in the United States, now well above 6%. Now, this is all in a response to inflation. The Federal Reserve wants to bring down inflation, so they want to reduce demand in our economy. Every single time they raise their interest rates, that makes it harder for people to spend money, because as things like auto loan prices go up and mortgage interest rates start to rise, that makes it a lot harder for people to get those things, and people are immediately disqualified from getting them. They can't afford the monthly payment, so they can't get a home. With people buying less homes and getting fewer mortgages, now the Federal Reserve can effectively bring down inflation because people aren't spending as much money. The Federal Reserve in this economy wants price stability, because if you've been to the grocery store recently or tried to buy anything, the prices for everything have gone way up over the last couple of years. This is because we've had a lot of spending related to the pandemic. The Federal Reserve printed trillions of dollars for quantitative easing on Wall Street and for federal government stimulus programs. So people were spending a lot, but we weren't really able to create enough during the pandemic, so everything kind of got behind. We have really high demand, but really low supply. Now we're starting to work on everything, but it's not really helping the housing market as of yet. The housing market is really tricky when it comes to inflation, because there's usually a lot more demand in the housing market than there is for supply. In 2020 and in parts of 2021, we've been trying to build more homes, and it was really lucrative for builders to do that because prices were going way up, but prices for everything have now gone up, and to build a home, it costs around $30,000, $40,000, and $50,000 more than it did just 3 years ago. So builders cannot get the same return anymore, so they're building fewer houses, and on the other side, Americans can't afford these new build prices, so they're not buying those houses either. So we're not able to build enough houses. Meanwhile, there's not a big enough supply of homes. Americans are not putting their house on the market right now because most Americans, seriously, around 30 to almost 50% of them bought a home or swapped homes over the last couple of years. That means that they got most likely a historically low interest rate, and they're not going to be selling for a very long time because sellers don't want to enter the market in 2022. They don't want to have to go out and buy a home again, especially since interest rates are going up. So that is keeping supply very low in the United States. Meanwhile, demand is still pretty high because the people that can afford to buy a home right now are still going out and getting a home. But we are starting to see mortgage demand drop dropped to a historic low. Like I said before, it's at its lowest point since 1999. While all of this was happening and inflation was affecting the housing market, well, there wasn't enough supply, but because of all of this money printing and government stimulus programs, people were going out and getting homes at record rates, meaning that price wars started to ensue. People were overbidding on every single home, right? So you had all of these homes that were now being pushed up in price by sometimes $100,000 plus. The homes weren't technically valued at that, but they are now because people were willing to pay that price for that home up front. So the prices of homes skyrocketed because everybody wanted to get in and buy a home during that time. What that did though was make home affordability go all out of whack, because while all of this inflation was growing in the United States, people weren't really making all that much more money, so they can't really afford to get a new home, or they couldn't afford the home that they just bought or have been living in. So they have to either sell their home or they're just not going to buy one. So like I said, home affordability is at an all-time low, and that means that people don't even want to go out and try to get a mortgage right now because one, home prices are out of control. If you're going to buy a home right now, you're going to overpay for it. And number two, mortgage interest rates are extremely high. So even if the home in say 2021 was overpriced, like they definitely were, you were still going to save some money because your interest rate was very low. It was still hovering around 0%. And that means that you were going to save hundreds of dollars on your mortgage every single month. But now in 2022, the same priced home is going to cost you an additional $100 or $200. And many Americans just don't have that extra cash. But now here's where things start to get really interesting in the housing market. Bank of America right now is offering a 0% down mortgage. So if you want to buy a home, you can essentially put nothing down and you will pay no closing costs either. This is obviously a big problem because it's very similar to what happened just before the crash of 2007. Many Americans were told throughout their entire lives that the home that you buy is the dream, right? A home is the American dream, and that's what everybody strives to get. Now, this was mostly pushed by the financial institutions and banks because they wanted people to buy hundreds of thousands of dollars worth of a home. They wanted you to buy a bigger and better home because you're going to grow into your home. It's a home for your family. And while all of this is true, many Americans were buying homes for all of the wrong reasons. They were buying a home strictly because they felt like they could make a profit on their home later on down the road. And this is a very emotional way to do anything, and it's something that you have to keep out of money. We don't know what's going to happen with any single market. And if you buy something solely on the belief that it's always going to go up in value because it's the American dream, well, I can almost guarantee you that that is not true. Every single market has its ups and its downs. And in 2007, that was definitely a down year for the housing market. You want to buy a home because it is something that your family is going to live in and you make memories on, but do not buy a home because you feel like you're going to invest in it and you're going to make a profit on it down the road. Yes, you might be able to make a small profit on your home and actually make some money out of it, but do not buy a home solely because of this. Buy a home because you want to have that home in that area for your family or for yourself. But this was the ideology that banks were pushing on people. So in 1999, we had an all-time low for mortgages. People didn't really want to get homes, and this meant that they had to switch the ideology on people, and that spiked mortgage interest in the United States. Not only that, but we had something called ninja mortgage loans. Essentially, these banks and financial institutions were not checking anything about the individual. They were barely even checking their credit. You could get a $100,000 plus mortgage with no income, no job, and no assets to your name. All you needed to do was walk into the bank and say, hey, I want a mortgage, and they'd give you one. That's because they were telling people that, hey, it doesn't matter. Even if you can't necessarily afford your home today, that's okay. You have an asset now. You can sell this home later on down the road because it's not going to matter. People are going to pay for it, and you're always going to have money from that. So you might as well buy a home. In fact, you might as well buy a huge home because that's going to be more valuable. Not only that, but we had subprime mortgages. So people were getting in on mortgages with really bad credit, and people were buying huge mortgages that they really couldn't afford. A subprime mortgage means that your mortgage interest rate is going to be a little bit higher because your credit is much lower, but that didn't matter to the bank. They were still giving out hundreds of thousands of dollars worth in a mortgage to pretty much any individual. And lastly, you had adjustable rate mortgages. So people were thinking that, well, maybe they couldn't afford a 30-year fixed mortgage, so they'd go in on a 15-year ARM, an adjustable rate mortgage. That meant that up front, their mortgage interest rate was going to be pretty low, but once the rates reset 5, 10, 15 years down the road, now you're gonna have to pay a whole lot more. And that is exactly what ended up happening. People were getting in on these mortgages and nobody could afford their homes anymore. So now you had a foreclosure crisis. But what I'm worried about in 2022 is we're starting to see a situation like we saw back in 1999 and the early 2000s. These banks and financial institutions know that homes are super unaffordable right now, so they are doing whatever they can to get people to buy a home. And that means zero money down and zero closing costs. What this ultimately leads to is millions of Americans that no longer can afford their home. And in 2022, the situation is definitely different. When I bought my home in 2020, they checked everything about my credit history. They checked everything about my income. If there was one single dollar that wasn't accounted for in my savings account, they wanted to know where it came from. So in that light, there is a lot of things that are different in the mortgage and the housing market. But at the same time, this Bank of America deal means that, well, even if you do have a decent job, that's all you have to have. You just have to show that you are employed, and that is the bare minimum. And the argument from banks and financial institutions is exactly the same as it was all the way back then. They're saying that you should buy a big home, you should buy a home in general because it's always going to go up in value. Right now, that has been true in 2022, right? Because houses have gone so far up in value and in price, even if they decide that they want to sell their home or they lose their job, for instance, or something else happens and they need money, they can always sell that home and they could get hundreds of thousands of dollars out of it because prices have gone up. The interesting thing right now, though, is mortgage interest rates are rising. So nobody is buying a home anymore, and demand is going down because of that, and supply is still really low. So now prices have to come back down to a realistic level. This means that people who have a lot of value and equity in their home are starting to lose a little bit of equity. And we're starting to see in some markets in the country that people are underwater. And if you're underwater on your mortgage, that means that you don't have enough to pay the mortgage back if you decide to sell your home. So people are just not going to sell. And if they do, well, they're going to be out a huge chunk of money. And the fact of the matter is we don't know how much lower demand in the housing market is going to get. And eventually, if we start to see demand that is getting a lot lower than the supply of homes available, then prices are going to drop drastically in the housing market, meaning that most buyers and most current homeowners are going to be underwater on their mortgage. They're not going to be able to sell their home. And that means that there is no activity in the housing market at all. There's no supply being added and there's no buyers being added. And that could eventually lead to an outright crash. This is the reality that we live in 2022. So if you are in the market to buy a home this year or in the near to distant future, here's my advice. Don't let the market determine whether or not you can afford a home. Sure, over the last couple of years, interest rates were low, but we don't know how long they're going to stay that low for. Instead, you need to decide for yourself if you're able to get a home. And again, don't try to buy a home to make a profit off of it or to flip it down the road. You want to buy a home because you want to start a family there, or you want to live there, or it's just your home center. It's where you feel the best at. That is an emotional decision, and that's something that you decide outside of money. And if your goal is to make money, there's other ways to do that, like through your job, through investing, starting a business, whatever it might be. There's other ways to make money, but your home is not necessarily an asset in that way. Your home is expensive, and I think that's what a lot of people are realizing in 2022. They're realizing that inflation is really high and insurance and taxes are going up on homes. So even after you buy one, you're going to have all of these additional costs, and that means that you're going to be in debt for a very, very long time. Not only that, but you have additional costs, like if your roof breaks, you've got to fix it, or your AC, something happens, you've got to fix it. Owning a home is expensive. It's a lot more expensive than other types of living. And like I said, we don't know what's going to happen next. The Federal Reserve is most likely going to continue to raise interest rates into 2023 because, well, inflation is still a problem in our economy. And this means that fewer and fewer buyers are going to be in the housing market. And even the buyers that are in the housing market, they can pretty much do whatever they want. This is a complete flip from what we've seen over the last couple of years, from a seller's market to now a buyer's market. Seller's market is they put up a house and 10, 20, 30, and 40 people bid on that house, and the price just keeps going up. So any anybody is gonna buy that home. It's a seller's market. But on the flip side, there's so many houses available, but not as many buyers. So there's only one buyer trying to get that home. They can basically bid whatever they want to. And we've started to see over the last 6 months or so, millions of Americans pull out of deals. They've got a house on contract, but they find something else, or they don't like the inspection contingency results. So they decide to not buy that home, and that leaves the sellers on the hook. And well, it means that the prices of those homes could get reduced even more. I think where we're headed next is a housing market that doesn't really have a whole lot of activity for a very long time. Housing prices are still way too expensive, and until the Fed continues to raise its interest rates way more, then that means that people are not going to be able to afford homes for a very, very long time. That will hopefully give supply enough time to catch up to where demand is, and then everything will kind of equal out at that point. But it's going to take us a good year or maybe even 2 years to get there. And that means that the housing market can expect some more pretty drastic changes over the next year or 2 years. Wait, what? But now I want to hear from you on this issue. What do you think about the housing market of today? Do you see some major parallels to what happened back in 2007? Or do you think that the housing market situation is completely different? Whatever your thoughts are, leave a comment below before you go. But that is it for today's business and financial news breakdown. Thank you so much for watching. If you want to stay up to date with all the top business and financial news from around the country, our team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. And if you want to stay up to date with me and everything else happening in the business and financial world, I'm putting out updates 7 days a week over here on this channel, and I've actually got another one ready for you right here, so be sure to check that out before you go. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.